Hey, what's up guys? Tonight's topic is how are international exchange rates set? Well, international currency exchange rate displays how much one unit of a currency can be exchanged for another currency. Currency exchange rates can be floating, in which case they change continually based on a multitude of factors, or they can be paid or fixed to another currency, in which case they still float, but they move in tandem with the currency to which they are paid. Knowing the value of the whole currency in relation to different foreign currencies helps investors to analyze assets priced in foreign dollars. For example, for US investors, knowing the dollar to euro exchange rate is value while selecting European investments. And declining US dollars could increase the value of foreign investment, just increasing US dollar value could hurt the value of your foreign investments. Well, key takeaways. Another key, one key. Fixed exchange rate regimes are set to a pre-established peg with another currency or basket of currencies. Two key, a floating exchange rate is one that is determined by supply and demand on the open market as well as micro factors. Three key, a floating exchange rate doesn't mean countries don't try to intervene and manipulate their currency price, since governments and central banks regularly attempt to keep their currency price favorable for international trade. Four key, floating exchange rates are the most common and became popular after the failure of the gold standard and the Bretton Woods Agreement. Well, floating versus fixed exchange rates. Currency's price can be determined in two main ways: a floating rate or a fixed rate. A floating rate is determined by the open market through supply and demand of global currency markets. Therefore, if the demand for the currency is high, the value will increase. If demand is low, this will drive the currency price lower. Of course, several technical and fundamental factors will determine what people perceive as a fair exchange rate and alter their supply and demand accordingly. The currency of most of the world's major economies were allowed to flow freely following the collapse of the Bretton Woods system between 1968 and 1973. Therefore, most exchange rates aren't set but are determined by ongoing trading activity in the world's currency markets. And well, factors that influence exchange rates. Floating rates. Floating rates are determined by the market forces of supply and demand. How much demand there is in relation to the supply of a currency will determine that currency's value in relation to another currency. For example, if the demand for US dollars by European securities, the supply-demand relationship will cause an increase in the price of the US dollar in relation to the euro. There are countless geopolitical and economic announcements that affect the exchange rate between two countries, but a few of the most common include interest rate change, unemployment rates, inflation reports, gross domestic product numbers, manufacturing data, and commodities. Fixed rates. A fixed or paged rate is determined by a government through its central bank. The rate is set against another major core currency such as the US dollar, euro, or yen. The maintains its exchange rate, the government will buy and sell its own currency against the currency to which it is pegged. Short-term move is a floating exchange rate. Currency reflects speculation, rumors, disasters, and everyday supply and demand for the currency. If supply outstrips demand, then that currency will fall. And if demand outstrips supply, and the currency will rise. Extreme short-term move can result in intervention by central banks, even in a floating rate environment. Because of this, While most major global currencies are considered floating, central banks and governments may step in if a nation's currency becomes too high or too low. A currency that is too high or too low could affect the nation's economy negatively, affecting trade and ability to pay debts. The government or central bank will attempt to implement measures to move their currency to a more favorable price. Micro factors. More macro factors also affect exchange rates. The law of one price dictates that in the world of international trade, the price of a good in one country should equal the price in another. This is called purchasing price parity. If price get out of whack, the interest rate is a country will shift, or else the exchange rate will change between currencies. Of course, quality doesn't always follow economic theory, and due to several mitigating factors, the law of price doesn't often hold in practice. Still, interest rates and relative prices will influence exchange rates. Another macro factor is a geopolitical reason, stability of a country's government. If the government isn't stable, the currency of the country is likely to fall in value relative to more developed, stable nations. Forex and commodities. Generally, the more dependent a country is on a primary domestic industry, the stronger the correlation between the national currency and the industry's commodity in prices. There is no uniform rule for determining what commodities a given currency will be correlated with how strong the correlation will be. However, some currencies provide good examples of commodity forex relationships. Consider that Canadian dollar is positively correlated to the price of oil. Therefore, as the price of oil goes up, the Canadian dollar strength tends to appreciate against other major currencies. This is because Canada is a net oil exporter. When oil prices are high, Canada tends to reap greater revenues from its oil export, giving the Canadian dollar a boost on the foreign exchange market. Another good example is the Australian dollar, which is positively correlated with gold, because Australia is one of the world's biggest gold producers. Its dollar tends to move in unison with price change in gold bullion. Thus, when gold price rises significantly, the Australian dollar will also be expected to appreciate against other major currencies. Maintaining rates. Some countries may decide to use pledged exchange rate that is set and maintained artificially by the government. This rate will not fluctuate intraday and may be received on particular dates known as revelation dates. Governments of emerging markets countries often do this to create stability in the value of their currencies. To keep the pledged foreign exchange rate stable, the government of the country must hold large reserves for the currency to which its currency pays to control exchange supply and demand. Where can I find foreign exchange rates? Foreign exchange rates are available on a variety of websites online. These sites display the numerical relationship between each currency. Many of these sites also have currency converters, showing how much of a certain currency costs another currency. One of the most popular foreign exchange rate sites is xe.com. What are exchange rates based on? Exchange rates for floating currency are based on the supply and demand of one currency versus another. The exchange rate between two currencies shifts as the supply and demand for each exchange. For fixed currency, the exchange rate is based on the pledge to another currency and exchange is accordance as the value of the currency exchange. What the factors affect foreign exchange rates? Factors that affect foreign exchange rate include the political climate of the country, inflation, public debt, GDP, confidence, central bank, government intervention, and the balance of trade. And the bottom line. Currency prices are determined in two ways. Fixed rates, floating rates. Fixed rates are pegged to currency while floating rates move freely with market demand. Nations attempt to manipulate their currency so that they remain strong and so that the demand for the currency is high in foreign exchange markets. And well, it's all, and I see you in the next episode, guys. Goodbye and good night.